Hello everyone. Today I would be talking about the top five things you should do when the markets are moving lower or in a stock market crash. This is a very common thing with the new investors who might have started investing in the year 2017, and they would have seen a completely a bull run for most of the time, and markets did crash a little in between, but it did recover big time, and it went on to make new highs. So the very first thing you have to understand that you cannot expect markets to go on a bull run like in the year 2017. So the recent crash in the year 2017, in February 2017, is an eye opener for many of the new investors. So let us go through the top five things you should keep in mind. So do not panic from market sentiments. This is the first thing I would like to advise. And As soon as the sudden volatility in the market and also the crash, many new investors feel very incredibly panicked, and many investors have even stopped their SIPs. Do not do this. So that I will discuss this in my second point, that stick to your financial goals. So whenever you would have started your mutual fund journey, if it was recent, then you would know that this has been started for a specific reason, like for your child's education or your retirement fund, etc. So mutual fund SIPs actually work very well in a crash too. And the best example would be the people who would have stayed invested in their mutual funds in 2008 market crash, the global market crash. Now many of them have incredibly increased their returns would have been amazing by this time, especially in 2017, the because of the bull run. So you should never stop your mutual fund investments. However, you should keep a track of your mutual fund investments and portfolio every 3 months, every quarter, or every 6 months, and do not panic by seeing your mutual fund investments go in negative. The third point would be to stay invested for a longer run, and this is very important for you to understand that mutual funds do not generate great returns in short terms. So over a period of time, your returns are compounded, and on an average, many people would have told you the compounding rate of interest of 15%. So if you would have got 20 to 30% returns in 2017, there is a possibility that you might get lower returns this year or the year after. But over a long period of time, the returns will be huge, and then the average is calculated between you can expect 15% for a really good mutual fund which you have invested for a long period of time. So please stay invested for a longer run. Apply right investment strategy is would be my next point. That means your financial goals should have your risk appetite also to be kept in mind. So many investors who actually use the lump sum investment method and not the SIP route should be very careful that markets fluctuate a lot, and SIP route is considered one of the best strategies I mean, you cannot time the market, but it's one of the best methods to time the markets, and that's the way you have to accumulate. You can accumulate more units during this time, and that's why you should never stop your mutual fund investments. Review your portfolio. Now this is something which I was talking about in my earlier points. um, you should never stop your SIPs. However, you should track your mutual fund portfolio every quarter or once in every 6 months would be my advice. However, that if a mutual fund is not performing in 3 months or 6 months or even a year, that is not the time to change your mutual fund investments. You need to remember that a mutual fund may not be performing well due to different factors in the short term, and you should give it a time to actually go ahead. And if you are good enough to review the stocks in the portfolio, then you can review it yourself, or you can even hire a financial planner to review the portfolio of your mutual funds. So that's very, very important. So these are my top 5 points which you should keep it in mind. However, mutual fund investments, to just add a little more to my last point, whenever you are reviewing your portfolio, if a mutual fund is not performing consistently for the last 2 to 3 years, you should review the portfolio of stocks, and not immediately jump into changing it, but review it why it may not have performed, and what are the chances that it can perform in the coming years, and based on that you should take a decision. And if the decision is something which you cannot make it yourself, then you should take the help of a financial advisor. All right, so those are my top 5 points which you should be doing in a crashing market. Hope you enjoyed this video, and if you have any comments on my videos or this video, please do write on the comments section for any kind of feedback too. I'll be happy to look through and go through your feedback to create more quality contents. Thank you, and I will see you again in my next video.